Fannie Mae, they decided to basically get rid of their minimum credit score of 620. So we're going to talk a little bit about that, so that way people can be able to go buy a home. But I feel that is giving a little bit 2008 kind of, you know, vibes of how they were just giving loans and all that.
So just to let everybody know that maybe hasn't gone through a long process on this. Normally, what you do when you buy a first home, you go to a bank, you go to a conventional bank, and there's loan protocol FHA, right, from the government that is backed by the government that most brokers will be able to offer to you as a first home buyer. And then one of the good things about this product is that it has lower credit scores than what the traditional conventional banks will require you to have for a better interest rate. Then, so you have these qualifications like years of income shown on a W-2 or 1099, right? You have to have a credit score of at least 620 to apply for this loan. You have to have no bankruptcies in your, like, I'm sorry, yes, bankruptcies, but it had to be clear in the last 2 years. But it's a little more flexible than if you go to a traditional conventional loan and you ask for a 30-year loan, fixed loan. And also you have the possibility of getting into a Fannie Mae loan and a FHA loan for 3.5%, which was not the case with conventional just a few years ago. But yeah, so now they're getting rid of that first criteria of 620 credit score, which a 620 score is considered average score, right? And now they're saying they're gonna remove that 620 from the criteria, which means they're going to look at different criteria. And we were looking it up just recently. What is the risk assessment going to look like? And it's still going to take in account your income. It's still going to take account the debts that you have, debt to income ratio. They're still going to take account your financial status. So how much savings you have, how much reserves you have, what kind of you have, regardless if it's traditional retirement account or other accounts that you have. And instead of looking at your credit score, it looks like they're gonna look at your financial um, record. So how much are you paying in rent? How often did you miss a payment? If you had a credit card, how many late payments did you had in the last 2 years? If you pay utilities, like how many late payments did you have there? If you have a rental car. So it's looking at your record without relying on the single three scores that you get from three different bureaus.
I can understand kind of like their thought process. And the average first time home buyer is now at age 40. And so this is going to possibly help people be able to get, their first home. But I'm hoping that we learned a few lessons from 2008 to where, like, okay, we're doing this, but we're going to add more criteria. Which, kind of like side note, when I was reading this, there's not too much information yet on this update, so it's just kind of like very surface level right now. I think that the PMIs can still require a minimum credit score, so you still can still deal with that. But yeah, I want to see, how do you think this is going to affect, if it's going to trigger something similar to 2008, and especially with the other thing we wanted to talk about was the possible, Trump's talking about maybe implementing a 50-year mortgage. So now you have those two things combined. So, like, what are your thoughts, Lynn, on, well, first let's talk about what he's thinking about the 50-year mortgage. I'll let you kind of like.
Yeah, I think he wants to definitely incentivize more people because housing affordability has been like a huge issue, especially in our markets, right, where we live for the longest time. And he wants to be able to say, I cure housing affordability. This is what I gave you guys. And, it's something that presidents in the past have done. Like, I remember Obama used to do the $8,000 incentive for
Mhm.
first home buyers as well, not too long ago, 2010, I think. Um, yeah, so those two things would eventually, I guess, move more buyers into the supply market, into the market, the real estate market. But at the same thing, it's the removing the safety guards that we learned we needed to have from 2008 from the crisis. It's kind of like going backwards to me. And I know it's very much to the individual. And when we're talking about like our community or the people that we know at real estate, this is opportunity. Like when I look at 50-year mortgages, I'm like, okay, well, how's this gonna benefit me, right? But for the average American, for greater, like majority of people purchase a home because they're gonna live in it, right? They don't see it as an investment. They're not thinking like future wise. This is just going to be something that produces me income or helps me along. It's more like an emotional decision. So when you see like the safeguards removed from there, and then you see yourself like, oh, maybe I can afford this home. And if you get a 50-year mortgage, you can afford a bigger home. So all of those things that people are gonna be like, well, I cannot only afford a $300,000 house, and I can afford a $450,000 house to be my forever home. And because we're taking the economic safety guards that we have now, it's very easy to be emotional about this impulse buy as opposed to being like, no, what is actually financially good for my family and for me in the long term, right?
It is a 50-year mortgage, meaning that you're gonna build equity so much slower, and if something happens, with layoffs going left and right, like, everything the job market is crap, you know, um and you lose your job and now you have to sell that house, like you might be in the negative because you have that 50-year mortgage. And as a real estate investor, I could see how we could use it, but I think it would definitely not like, well, like if you're going for cash flow is definitely a good thing and you're not too worried about equity, which is my kind of type of investment. I look more for cash flow, so not too focused on appreciation and equity too much.
We are looking next year to get into a live and flip. So purchase something that is, depleted, outdated, and live in it and then flip it because we're one of those people that still have student loans. So like the student loans are hindering us, him and me. And so we want to use that money to pay off his student loans. And then so if a 50-year mortgage is there and we're buying something at a discounted price and we forcing value into it and when we flip it after 1 or 2 years, really it doesn't affect us. It's only going to benefit us that we paid a mortgage that was lower monthly for the first 2 years that we were in the house when we already get it at a discounted price. So I see a lot of benefit on that type of mentality and that type of investment, but I can see how it does not benefit other people.
I just see too many negatives. Can you imagine like going back to the median home buyer age now is age 40, so then getting a 50-year mortgage, like you're going to be 90, still, forced to work because you're still paying the mortgage. Retiring early is basically out the window because you're going to have to like worry about that.
Yeah, and like building journey was mentioning too, like the result of this going through, the result it's gonna bring more buyers into the market, right? It's gonna bring and then so also the 50-year mortgages is gonna have there's gonna be more lenders, more people are gonna qualify because now like their principal goes down and the monthly mortgage goes down. So there's more buyers in the market. So what happens when you increase demand in a market? Right? Prices are going to go up. Housing is going to go up because now we have an influx of buyers. So the long-term effects of this is just our assets are going to get higher. Our appreciation is going to grow, but housing prices are also going to rise.
It's going to put like too many people at risk now, and I'm just worried about that because I like you said, it's gonna be a lot of emotional buying, I think. And we had that already where people were buying these houses at the top of their budget. One, because of like house prices the skyrocketed anyways. So I guess just more education. I feel like most people will not go for the 50-year mortgage. Let's say it was offered. I don't know. I don't think people will still want that 50-year mortgage, especially if they're at like their 30s or 40. I could see maybe like a someone in their 20s probably going because they're like, I got plenty of time to pay this house off.
I think my age demographic, which people's in their 30s, because I feel the angst around my friends of like not being able to homeowners. And they're in their 30s, they're starting families because we're starting families later and later now. And then so, instead of like looking at cheaper markets, they are like just talking about like how it's completely unaffordable to get into a house. But when I was looking at the numbers really, between a 30-year mortgage and a 50-year mortgage, your principal only goes down so many hundreds of dollars, maybe like $200-300 monthly.
Mhm.
And that might be enough to get you qualified to get into the house, but it doesn't seem like a significantly amount with this interest rates, unless interest rates fall. Then it would be a significant amount of buying power, right, monthly. Because if you're expected to have less $200 for the same mortgage for the same house, then I don't see how that would really make a dent, like 1,200 a year.
I didn't think about that as well, which goes back into the emotional buying because they are probably feeling like, "Oh, wow, like, I'm in my 30s and I still don't have my house," or, "I have kids already and I would like for them to have a home." But that's what my thoughts were. Again, like, gotta see if Fannie Mae puts out more information. Probably not. I think that's just as much as information that, no more minimum credit score. But it's only through, what was it called? Their system. Like, it's basically just a credit risk analysis or whatever for them. So they're just removing it so that way you could get more of a whole picture of the person that's trying to get a loan instead of just relying on credit score. But again, like I said, shoot, the a PMI is probably still require a credit score for another lender, or like if they sale it, it's still like, you know,
Yeah.
this Fannie Mae thing. Other things can still require it.
Mhm. Yeah, I think it's you're mentioning how like there's a lot of people that this may be helpful for a lot of people that have had their credit scores tarnished for different things like
Mhm.
emergencies, medical emergencies that they had, right? That to put in a credit card and not able to pay it, or uh, the credit card going bad because of student loans that you defaulted on, or even instances in which like family members have used their social security and
Mhm.
to work and to use and to accumulate credit card for the family, right?
Mhm.
And then they're not able to get rid of that. I remember I had a friend that had cancer early on in his 20s. Even though he had insurance, he had to cover a lot of things in his credit cards, and he wrote like extensive letters for like 10 years to the credit bureau, and they were able to like uplift up a bunch of those medical bills that were defaulted early in his 20s because he had cancer. His credit score like recover, right? So those things like that, I can see how it helps to people.
So something like this would be beneficial for people like that instead of having to wait years or however long to fix that credit for a poor decision, or not even a poor decision, just life happening with your friend with cancer and things like that. They have to prolong of when they could buy their first house or a house just because of that. So I could see the benefit of that helping people like that for sure.
Yeah, and I believe in then within our community too, a lot of older peeps do like to purchase everything cash and do not
Mhm.
like to purchase credit cards and do not like credits, right? Reporting things. So like they've been having stable incomes for a long time and led successful businesses and have no debt. But that there's the downside of that, which you have no credit history there also as well. So to those people that are like looking at this, they would be beneficial.
Yeah, I think I didn't have a credit score until I was like 23. I started because I think that's when I went and actually bought a car. And having no credit score really like messed me up. I had like a really high interest rate. So it wasn't until maybe 26, I want to say, which is when I bought my first house. Because of that car, then I was able to buy have a credit score, and then I also lucked out because I used the VA home loan. So that was available to me, so I was able to purchase. But other than that, I mean, I would have had just one loan, and I'm gonna have to go back and look and see if I
Mhm.
could find those loan documents because I don't remember what my credit score was at that time. So I wonder what it was. I'm pretty sure it was kind of like around six something as well. Like the people you were talking about that I did everything cash. I mean, I didn't get a credit card or nothing.
Yeah, and I also now makes me think like if you remove credit card out of the equation, then do we get the same interest rates FHA? Because FHA is known to have lower interest rates than conventional, right? Like a little bit, like maybe 1/8 of a discount. Um, does that mean are we gonna get like competitive higher credit like interest rates now because there's no credit score to like, if your credit
Yeah,
score is
that's right.
lower, then that means your interest is a little bit higher. And now your credit score is a little bit higher, then your interest is a little bit lower. So like how's that gonna play into effect? Yes, and we wanted to bring you up this topic because if this becomes a reality, it gives us investors more options to get into real estate, like 50-year mortgages, for example. We were talking with Violetta and how much of a difference would it make for us to get a 50-year mortgage versus a 30-year mortgage. First of all, more cash flow, and that's like our goal with investments. And also, then you would be able to cash flow better for the foreseeable future. Like I was mentioning in flipping, if you decide to go live and flip, it doesn't really matter much. For me at 30 versus 50-year mortgage. So that's a good benefit. And then you have to take how the economy is evolving into you have to take how it benefits you. Like that should be
Mhm.
your question. How does this benefit me?
Yeah. Yeah, like for me, I don't think for cash flow would work, but if you're that type that is like kind of trying to do some burrs or whatever, let's do like forced appreciation, like refinancing is not going to be because you don't have that much equity. And then assuming like, what about the down payment part? Like a lot of them don't, like some of them are like 3.5% and stuff like that. So you're already going in with very to no equity, and then you're gonna, you know, appreciate slower and get equity slower because you're paying very little towards the principal.
And at the end of 50 years, who's winning? The banks, because they're getting more interest rate for 50 years for sure.
Yeah, but hopefully we don't have to bail them out again.
2025 is turning out very interesting.
Yeah.
And there's a lot of changes for sure. Yeah. And just to wrap it up today, we will try to get back to you guys with the news, the most upcoming news. So we'll see each other next week. And if you have any comments, please like and subscribe to the channel if you haven't already done. For real estate, have us, and we'll keep bringing you more useful information.
Yep. Hey, bye, guys.